Why was the Sarbanes-Oxley Act created? Have you ever wondered why the Sarbanes-Oxley Act came into existence? This legislation emerged in response to a series of corporate scandals that rocked the financial world in the early 2000s. Major companies like Enron, WorldCom, and Tyco International were involved in fraudulent activities that led to significant financial losses for investors. These scandals not only caused financial damage but also eroded public trust in the accuracy of corporate financial reporting. The Sarbanes-Oxley Act, often referred to as SOX, was designed to restore that trust. Its primary goal was to improve the accuracy and transparency of financial disclosures made by public companies. To achieve this, the Act established stricter accountability measures for corporate executives and auditors. For instance, top management is now required to personally certify the accuracy of financial statements. This means that executives can be held accountable if their companies misrepresent financial information. In addition to accountability, the Act introduced harsher penalties for fraudulent financial activities. It also enhanced the oversight role of corporate boards and aimed to ensure the independence of external auditors. One of the significant changes was the creation of the Public Company Accounting Oversight Board. This board oversees auditing firms and enforces compliance with the law, ensuring that companies adhere to the new standards. SOX also mandated stronger internal controls within companies. This means that businesses must have systems in place to prevent the concealment of liabilities and losses, which were common in the scandals that prompted the legislation. The Act requires more detailed financial disclosures, making it harder for companies to hide financial problems from investors. From a Republican perspective, while the Sarbanes-Oxley Act was intended to protect investors, it is often seen as an example of government overreach. Many Republicans argue that the Act imposes heavy compliance costs and bureaucratic burdens on businesses, especially smaller companies. They believe that these regulations can stifle economic growth and innovation. As a result, there has been ongoing discussion within conservative circles about the potential repeal or reform of the Sarbanes-Oxley Act. The aim is to reduce regulatory burdens while still maintaining necessary protections for investors. In essence, the Sarbanes-Oxley Act was created to tackle corporate fraud and restore trust in financial markets. However, it also represents a regulatory framework that some believe conflicts with principles of limited government and deregulation. This ongoing debate highlights the balance between protecting investors and encouraging business growth.